In the spring of 2008, while Bear Stearns was collapsing and Lehman Brothers was still telling clients everything was fine, the wealthiest families in America were not watching CNBC. They were quietly executing a playbook that has existed for centuries, moving their core wealth into vehicles that the traditional financial system cannot touch, cannot lend against, cannot margin call, and cannot freeze. Most Americans never knew it was happening. By the time they understood what had occurred, the S&P 500 had fallen 56.8% from its October 2007 peak to its March 2009 bottom. $11 trillion in household wealth had been destroyed, and the families who had executed the exit strategy. They emerged from the crisis wealthier in real terms than they entered it. That playbook is being executed again right now, today, this week, in early April of 2026. And the conditions driving it are, by every quantitative measure available to institutional analysts, carrying echoes of the stagflation pressures seen in the late 1970s, even as growth signals show some resilience in early 2026 data. Recent GDP readings reflected softness in late 2025, with Q for coming in well below expectations amid policy transitions, while Q1 2026 nocasts point to a potential rebound. The average effective tariff rate on American imports has shifted significantly in recent years, climbing from around 2.5% pre-2025 to elevated levels through 2025. Before partial adjustments, still representing a historic policy shock not seen in decades, Goldman Sachs has placed the probability of a U.S. recession over the next 12 months in the 25-30 range as of late March 2026 updates. J.P. Morgan's assessments hover around 35% for us and global recession risks in 2026. Consumer confidence remains pressured from pandemic-era lows and ongoing uncertainties, and the Federal Reserve continues to navigate a complex environment balancing growth support against lingering inflation risks from supply chain and trade adjustments, with the bond market pricing potential rate cuts through 2026 while tariff effects and other factors keep price pressures in focus. This is the exact environment in which the exit strategy matters most, not when markets are calm, not when the Fed has unlimited room to maneuver. When markets are calm and the Fed has room, the traditional system works reasonably well for the people inside it. It's in moments like this one when the system is simultaneously facing growth moderation risks and residual inflationary pressures from trade policies, when the bond market is pricing multiple Fed rate cuts through 2026 while other forces drive selective price increases, when the dollar contends with a national debt now exceeding $39 trillion and ongoing global realignments, that you discover whether the vehicle your wealth sits in was built to protect you or built to protect the institution that holds it. The answer, for most Americans, is the latter. Here is what I mean by that, specifically. When your money sits in a traditional bank savings account and the FDIC national average savings account rate as of March 2026 sits at approximately 0.39%, your deposit is not your asset. Legally and structurally, your deposit is a loan to the bank. The bank takes that money and lends it out to mortgage borrowers, to corporate borrowers, to other financial institutions. The bank earns significantly higher rates on those loans. It pays you 0.39%. The spread between what the bank earns and what it pays you is not compensation for services rendered. It is the cost of your ignorance and your inertia, monetized at scale across hundreds of millions of Americans. And if the bank makes enough bad loans, as they did in 2008 and as they did during the regional bank stresses of March 2023 when Silicon Valley Bank, Signature Bank, and First Republic collapsed in a span of 6 weeks, you are relying on FDIC insurance to get your money back. FDIC insurance is real and it is reliable, but it only covers $250,000 per depositor per institution. And the process of recovering funds from a failed bank is not instantaneous. When your money sits in a brokerage account invested in stocks, it is subject to every force that moves markets on any given day: algorithmic selling, margin calls, geopolitical shocks, earnings disappointments, Fed communication shifts, and the mechanical deleveraging that occurs when millions of American margin account holders get simultaneously squeezed in a falling market. Institutional notes have highlighted how algorithmic funds are now positioned to sell in virtually every scenario. Falling markets trigger momentum selling, rising volatility triggers volatility targeting funds to reduce exposure, and correlation spikes during crises cause every asset to be liquidated simultaneously, including the diversification assets that were supposed to protect you. The Nasdaq and S&P 500 have shown volatility in recent quarters, with rotations out of certain US equities into other regions noted in fund manager surveys. When the largest institutional allocators in the world adjust their US equity exposure at notable paces, you need to understand what they are moving into, and you need to understand whether the vehicles they are moving into are accessible to you. They are. That is the entire point of this video. There are 3 specific vehicles that central banks, sovereign wealth funds, pension funds, and the wealthiest families in the world use to protect the core of their wealth when the traditional system comes under stress. Every one of them is completely legal. Every one of them is regulated by the United States government. Every one of them is accessible to any American with a few $100s, a social security number, and an internet connection. And every one of them has a specific quantifiable advantage over leaving your money in a traditional bank savings account or a brokerage account exposed to the full force of what is coming. Let me take you through all three of them, exactly as a private wealth strategist would explain them to a client paying $50,000 a year for the access you are about to receive for free. The first strategy is the oldest wealth preservation mechanism in human civilization. Physical precious metals, gold and silver held in your direct possession, outside of any financial institution, any brokerage, any fund structure, and any intermediary who could freeze, lend against, or hypothecate your assets. Gold has been trading in the $4,500 plus per ounce range in recent sessions as of late March into early April 2026, reflecting strong performance amid global uncertainties and outperforming many traditional assets in relative terms over recent periods. Institutional forecasts from major banks continue to eye upside potential in various scenarios involving currency pressures or further realignments. But the price forecast is not the reason physical gold belongs in your exit strategy. Price forecasts can be wrong. Markets can be irrational for longer than you can remain solvent betting on them. The reason physical gold belongs in your exit strategy is structural. It is about the nature of the asset itself, independent of its price on any given day. When you own a 1-ounce American Gold Eagle, a quarter-ounce coin for smaller initial positions, or a 1/10-ounce coin at current pricing levels plus dealer premium, you own an asset with what institutional strategists call zero counterparty risk. That means there is no institution, no government, no corporation, and no individual whose promise is required for your gold to have value, unlike a stock, which is a claim on a company's future earnings that the company must generate and distribute, unlike a bond, which is a promise by a government or corporation to repay principal and interest that they must honor, unlike a bank deposit, which is technically an unsecured claim against the bank that must honor the liability. Physical gold in your possession is the asset itself. Its value does not depend on anyone's creditworthiness. Its availability does not depend on anyone's operational competence. Its existence does not depend on any institution remaining solvent. This is the precise reason that the institutions responsible for managing the global monetary system have been accumulating it at elevated paces in recent years. Central bank purchases have remained robust since 2022, with many nations adding to reserves amid de-dollarization discussions and reserve diversification trends. The People's Bank of China, Poland, India, and others have featured in these flows. Gold has maintained its position as a key reserve asset, with the dollar's share of global reserves facing gradual pressures over time. Let me give you the historical anchor that makes the current moment legible, because without it, the numbers can feel abstract. In the late 1970s into 1980, Federal Reserve Chairman Paul Volcker faced an inflation problem with energy-driven and sticky characteristics. Inflation peaked near 14.8% in March 1980. The Fed funds rate was eventually raised sharply. The economy entered recessions. During that period, gold rose dramatically from lower levels to $850 per ounce, a massive gain in a short time. Then it corrected as tightening took hold. The investors who held physical gold through that entire cycle, who did not panic when it corrected, who maintained their position as part of a disciplined allocation, emerged from the stagflation era with their purchasing power better protected, while equities struggled in real terms over the decade. The 1970s analog is not perfect. No historical analog ever is, but the mechanism shares similarities: trade and energy-related price pressures, a central bank balancing mandates, dollar considerations under fiscal strain, and shifts in how global institutions manage reserves. Elements of those conditions persist or echo into early 2026. Here is how you execute this strategy as an individual investor. The U.S. Mint produces American Gold Eagle coins in 4 denominations: 1 ounce, half ounce, quarter ounce, and 1/10 ounce. American Silver Eagle coins offer an accessible entry point depending on current dealer pricing. You purchase from a reputable dealer with a strong track record, transparent pricing with clearly disclosed premiums over spot price, and accreditation through industry organizations such as the Industry Council for Tangible Assets or the Professional Numismatists Guild. You take physical delivery. You store it in a home safe that is bolted to the structure, a private safe deposit box, or a private non-bank depository. The metal is yours. No fund manager can freeze your account. No brokerage can issue a margin call. No bank failure affects it. No algorithm can sell it. The one honest limitation of physical metals is liquidity. Selling requires contacting a dealer, arranging shipment or in-person transaction, and waiting hours, 2 days for settlement. This is not a checking account. It is a foundational wealth preservation layer, not a trading vehicle. Most serious wealth preservation frameworks recommend 10 to 15% of total assets in physical metals, providing a base of zero counterparty risk assets beneath whatever market exposure you carry above it. The second strategy is the one that generates the most frustration among financial professionals who understand it, because it is perhaps the most obvious and most universally ignored financial opportunity that the U.S. government offers. TreasuryDirect.gov, the official website of the United States Department of the Treasury, Bureau of the Fiscal Service, where any American citizen or resident can open a free account and purchase U.S. government securities directly from the source, bypassing every bank, every broker, every financial advisor, and every fee that normally stands between you and the highest quality fixed income instrument on earth. No financial institution profits from telling you about Treasury Direct. Your bank does not want you to know that you can move money from their low-yield savings account into a government-guaranteed instrument yielding multiples higher. Your financial advisor does not want you to know that you can purchase the same treasury securities they would buy for you at the same price, with the same terms for zero commission, zero management fee, and zero annual administration cost. And the financial media covers it rarely because a government website that charges no fees generates no advertising revenue. The flagship product on Treasury Direct for this specific moment in early 2026 is the Series I savings bond, universally known as the I-bond. I-bonds are inflation-protected savings bonds that currently pay a composite rate that consists of two components: a fixed rate that is set at the time of purchase and never changes for the life of the bond, plus a variable inflation component that resets every 6 months based on changes in the consumer price index for all urban consumers. For I-bonds purchased through April 2026, the composite rate sits around 4.03% based on recent announcements, 0.9% fixed plus inflation component. Now compare that to the national average. The FDIC reports the national average savings account rate near 0.39% as of March 2026. For an investor with $100,000 in a traditional bank savings account turning the national average, that money generates roughly $390 per year at a 4 I-bond composite rate. That same $100,000 generates about $4,000 per year, a substantial difference annually for doing nothing more than redirecting the money from one government-backed vehicle to another. Over 5 years at a constant differential that could shift with inflation data, the cumulative difference is meaningful on a $100,000 position. But the rate differential, substantial as it is not the most important feature of I-bonds in the current environment. The most important feature is the inflation protection mechanism itself. Because the variable component of the I-bond rate resets based on CPI data, I-bonds purchased today will automatically adjust if price pressures evolve over the next 12 to 18 months. If tariff-related or other pass-through effects influence CPI, the variable component captures that, meaning the bond that earns you around 4% today could adjust accordingly, with no action required on your part. And here is the structural guarantee that makes I-bonds categorically different from every other fixed income instrument available to retail investors. The face value of an I-bond cannot decrease. Unlike a treasury note or a corporate bond, which loses market value when interest rates rise, unlike a bond fund, whose NAV fluctuates daily based on rate movements, unlike a stock that can fall sharply in a bear market, an I-bond's principal is mathematically protected. Even in a deflationary environment, the rate simply falls to zero. It does not go negative. Your principal is guaranteed by the full faith and credit of the United States government, which has never defaulted on a domestic obligation in its history. The purchase limit is $10,000 per individual per calendar year for electronic I-bonds purchased through Treasury Direct. A married couple can purchase $20,000 per year. Investors who are due a federal tax refund can direct up to $5,000 of that refund into paper I-bonds, bringing the individual annual total to $15,000. I-bonds cannot be redeemed before 12 months. If redeemed between 12 months and 5 years, the investor forfeits the most recent 3 months of interest, a modest and transparent penalty. After 5 years, there is no redemption penalty. I-bonds earn interest for 30 years. Beyond I-bonds, Treasury Direct offers the full suite of U.S. government securities. Treasury bills with short maturities currently yielding in ranges that far exceed savings accounts. Treasury notes with 2 to 10-year maturities. Treasury inflation-protected securities TIPS whose principal adjusts with CPI floating rate notes. Every single one of these instruments is held directly in your Treasury Direct account, registered to your Social Security number, with interest and maturity payments deposited directly to your linked bank account. Zero fees, zero commissions, zero fund managers standing between you and the U.S. Treasury. The historical precedent for this strategy includes periods like the early 1980s, where investors who went directly to government securities locked in yields that helped protect purchasing power. The mechanism is similar today. The institutions with the most at stake are not parking cash at 0.39% in savings accounts. They are utilizing short-term government instruments. Treasury Direct lets you do the same thing, at comparable rates, for free. The third strategy, the one that combines the counterparty protection of physical metals, the tax efficiency of retirement law, and the inflation hedging properties of hard assets into a single vehicle, is the self-directed Precious Metals IRA. A self-directed IRA is an individual retirement account that the IRS explicitly permits to hold alternative assets beyond the traditional stocks, bonds, and mutual funds found in a standard brokerage IRA. The IRS code permits self-directed IRAs to hold certain approved physical precious metals, including American Gold Eagle coins, American Silver Eagle coins, and qualifying bars meeting fineness standards. The mechanism is straightforward once you see it clearly. Economic growth showed softness in late 2025 before potential Q1 2026 rebound signals. Tariff policies have contributed to price adjustments at the same time as growth moderation risks creating stagflation-like tensions in policy debates. The Federal Reserve balances stimulation against inflation control. The dollar faces structural considerations with debt above $39 trillion. And in every historical instance where similar convergences occurred, the assets that protected wealth were the ones that required no institutions promised to deliver their value physical metals with zero counterparty Risk, direct government securities held outside any bank or broker, and legally protected retirement structures that survive whatever happens to any individual financial institution. Goldman Sachs recession probability assessments in the 25-30 range, JP Morgan around 35%, and fund manager surveys noting equity rotations. These are positions from institutions managing vast capital. The three exit strategies outlined in Part 1 are the vehicles those institutions use for their own core wealth. Let me now give you the specific investment mechanics, the return mathematics, the rules that govern crisis investing across decades, and the honest risk assessment that any serious analyst toes their audience. Physical precious metals execution, sizing, and return mathematics. An investor building a physical metals position in early April 2026 has four primary options at different price points and with different liquidity profiles. The 1-ounce American Gold Eagle is the most widely recognized, most liquid, and most straightforward currently available from established dealers reflecting spot prices in the $4,500 plus range plus premiums of roughly 2.5. Smaller denominations like quarter-ounce or 1/10-ounce offer incremental entry points. American Silver Eagle coins provide exposure with silver's volatility characteristics, supported by industrial demand in solar, EVs, and electronics amid supply constraints. The return mathematics for a 10% physical metals allocation in a $200,000 portfolio are illustrative based on scenarios. At current levels near for 500 for 800 Oz, a position buys a certain number of ounces in institutional upside scenarios or historical proportional moves during stress periods. The asymmetry shows bounded downside as a last resort asset versus meaningful upside potential supported by precedent. These are scenario analyses, not precise predictions. The point is to understand the role the physical metals position provides the counterparty risk-free foundation. The rest of the portfolio can take measured market risk above that foundation because the foundation itself cannot be margin called, cannot be frozen, and cannot go to zero. The sizing discipline is non-negotiable. 10% to 15% of total assets in physical metals is the framework that wealth preservation advisors have used for decades. Not 50%, not 100%. Treasury direct execution, sizing, and the specific instruments for the current moment. For an investor executing the Treasury direct strategy in Q2 of 2026, the practical framework involves two distinct positions serving two different purposes. The I-bond position up to $10,000 per individual or $20,000 per couple per calendar year serves as the inflation-protected component of cash reserves. The upcoming rate reset around May 2026 will incorporate fresh CPI data. I-bonds purchased before the April 30, 2026 cutoff lock in the current fixed-rate component while positioning for variable adjustments. The T-bill position serves as the liquidity management component short-duration vehicles for cash that needs to remain accessible within weeks. Short-maturity Treasury bills currently yield levels well above savings accounts. An investor can establish a ladder purchasing new bills on a rolling basis that ensures a portion of cash is always maturing and available, while the full portfolio earns the Treasury rate rather than the bank savings rate near 0.39%. The dollar difference, made concrete. A retired investor with $150,000 in cash equivalents earns minimal income at the national bank average. That same $150,000 in a T-bill ladder at higher short-term rates generates substantially more annually. Over years, that differential adds up meaningfully. TIPS deserve mention for longer horizons. They provide real yields above CPI with principal adjustment. Historical periods like the 2000s showed TIPS compounding real returns while equities delivered limited real gains over a decade. The self-directed Precious Metals IRA execution, the rollover mechanics, and the complete cost structure. For investors with existing retirement accounts, the self-directed Precious Metals IRA rollover can be consequential, converting tax-advantaged capital into physical, zero counterparty risk assets inside a tax structure that provides tax-deferred or tax-free growth. The execution sequence. Select a custodian with experience in alternatives, for example, firms administering billions in such assets. Initiate a direct trustee-to-trustee rollover check payable to the new custodian for your benefit, not to you personally, to avoid tax treatment as a distribution. Direct the custodian to purchase approved metals. The custodian arranges delivery to an approved depository. Metals are allocated, insured, and audited. The Roth conversion decision requires careful analysis. Converting means paying income tax on the amount in the year of conversion. For example, on a $200,000 conversion in a 24% bracket, there is real tax liability that must be paid from other funds. The case for doing so rests on assumptions about asset appreciation. Future tax rates with 39T plus debt context and long holding periods. All are defensible but not guaranteed. Consult a qualified CPA for your situation. 3 rules from 4 decades of crisis investing. The first rule: the asset that preserves wealth in a crisis is never the most popular asset in the preceding bull market. Consensus favorites often underperform when conditions shift. The assets that preserve are often the ones viewed as boring or unnecessary beforehand. The second rule: the window for executing the exit strategy is always shorter than it appears. In 2008, those who acted earlier in the spring preserved more than those waiting for certainty that never fully arrived before conditions worsened. The third rule: diversification within the exit strategy itself is not optional. Physical metals, treasury direct instruments, and self-directed IRA structures serve different purposes, have different liquidity profiles, and hedge different risks. No single vehicle is sufficient. The framework works because all three layers complement each other. Honest risk assessment, the three scenarios that would materially reduce the expected returns of this framework. Any analyst who presents only the bull case is not giving you analysis. They are giving you marketing. Here are the three specific scenarios that would challenge this framework. The first is rapid, credible de-escalation or reversal in trade policies that reduces tariff-related price pressures significantly. Inflation expectations could fall, opening different policy paths, and gold could face headwinds as in post-1980 disinflation periods. This deserves honest acknowledgement as a material risk. The second is a sharper Fed policy shift toward tighter rates if inflation reaccelerates. This could strengthen the dollar temporarily and create headwinds for gold, while benefiting short-term instruments. The Fed has surprised before. The third is unexpected fiscal consolidation that restores stronger confidence in U.S. finances and the dollar. With debt above $39 trillion, the probability is assessed as low by many analysts in the current environment, but not zero. It would be dollar positive and to some degree, pressure gold. These risks are real, they are quantifiable, and they are the reason that the sizing discipline 10 to 15% in physical metals, emergency fund in T-bills and I-bonds, a portion of retirement assets in the self-directed IRA, not 100% of everything in any single vehicle is essential. It is the structural acknowledgement. That confidence is not certainty. The specific triggers you can monitor in real time. The first trigger, gold's 50-day moving average relative to its 200-day moving average. A golden cross has historically confirmed sustained uptrends. Monitor for reversals that might signal shifting institutional momentum. The second trigger, the I-bond rate announcement around May 1, 2026. If the inflation component comes in strong, it validates protection aspects. Lower readings would suggest milder pass-through effects. The third trigger, the Fed's dot plot at upcoming FOMC meetings. Projections for fewer or more rate cuts signal the balance between inflation control and growth support. The fourth trigger, monthly World Gold Council central bank demand data. Sustained high purchases confirm structural trends. Drops below recent averages would warrant reassessment. The fifth trigger, the dollar index DXY relative to key moving averages. Breaks lower or recoveries can influence flows into alternatives like gold. The historical closing statement. In August of 1971, Richard Nixon announced the suspension of the dollar's convertibility into gold. Most Americans did not grasp the full implications immediately. Those who understood the shift from gold back to pure fiat moved accordingly. Gold rose dramatically in the following years. The investors who acted on the mechanism, not the reassurances, benefited over time. The mechanism in 2026 is not identical to 1971. It never is, but the core dynamic involves structural transitions in value storage, fiscal considerations with 39T plus debt, geopolitical elements, and institutional shifts already underway. Central banks have diversified reserves. Institutional rotations have occurred. The structural move is in motion. The only question is whether you participate in the framework that protects those who understand it, or remain in the one that extracts value from those who don't. The exit strategy is not about fear. It is not about predicting catastrophe. It is about understanding that in every period of genuine systemic stress in the past century, the assets that protected wealth were not the ones the mainstream financial industry promoted at the peak. They were the assets that required no institution's promise, that had been validated by centuries of monetary history, that were available to anyone who took the time to understand how they worked. You now understand how they work. The tools are in your hands. The window is open. The triggers are specific and monitorable. What happens next is up to you. If this channel delivers the kind of institutional level analysis that your bank, your broker, and your financial advisor will never give you because none of them profit from your being fully informed, then subscribe. Every week, we break down exactly what the smartest money on earth is doing, translated into the specific, actionable moves that everyday Americans can execute with a computer and an internet connection. That is the only promise this channel makes, and it is one we intend to keep.